Well, what we're going to do now is populate our spreadsheet. And the spreadsheet's going to help us with sequence of return risk and better understand that withdrawal risk. So let's go ahead and start populating, and we're going to draw some numbers. These are actual returns of S&P 500, the AGG bond index, and the NCREIF land, specifically row crop valuation data. So we've got real numbers, real returns in these buckets. Let's go ahead and give it a whirl. All right, we've pulled 21 returns, again, from the S&P 500, from the AGG aggregate bond index, and then from a land portfolio as well. So what do we have next? Well, if you see how I've set the spreadsheet up, I'm assuming this retiree has a $2 million initial portfolio to pull from. So we're gonna say you got $2 million, it's gonna sustain you through retirement. How much cash flow do I need? Gross of tax, we're gonna look at 5% withdrawal rate. So we're going to take 5% of that $2 million, comes out to about $8,333 a month. And we're going to inflate that annually at 3.26%. So every year we're going to pull a little more out, a little more out, a little more out, a little more out. Okay, so we're going to kind of see a sequence of withdrawal risk modeled right off the bat here, because our first year stock pull was negative 18. Now that's really going to hurt our S&P 500 portfolio, right? Can you imagine starting with 2 million, you pull 8,333 out a month, and at the end of that year, you're down almost $500,000? I mean, the staggering emotional cost here is pretty grand. Like that's gotta hurt. Then we have a 60-40 stock bond portfolio where it comes out to a little more hedged, and then we have a portfolio with land where I've done 40, 25, 35, 40 stock, 25 bond, and 35 land. And so you see that land portfolio is gonna be a little more steady through this journey. Okay. So the sequence of withdrawal risk, we're seeing it right away. Now, in year 2, we kind of have a flipperoo, right? In year 2, our stock pull was really good. I think it was the 2023 stock pull, and it came out to 31.49. So boom, we're back, everybody, 1.5 to 1.9, all right? And we can see our stock and bond bolstered. We can see our land bolstered. Everything is coming back up rosy. And there's a story here in holding the line and being consistent, but I'm not sure too many investors would actually do that. You'll see the inflated monthly withdrawals come out. As we go through the model, we've got years 3, 4, 5, 6, and you can see those dynamics that we pulled from these bins. We have some really good equity returns years 3, 4, and 5, and then kind of flubs a little towards the end, but the equity returns are strong enough here to drive this entire model. You're fine at the end with stocks, you're fine at the end with bonds, you're fine at the end with a blended portfolio that had land in it too. So as you get to year 7, you kind of see these dynamics. Now, this is great on paper, but the reality is in the sequence of withdrawal risk, this first year, if somebody started at 2 and ends at 1.5, are they really gonna keep pulling the same amount out? I don't think they are. I think it's time to reset. So you can kind of look at a few metrics that I think are interesting to the right here. You have these geometric mean values. Geometric mean assumes I didn't pull any money out. It's just like if I take the average of those returns. So geometric mean is going to be fairly consistent between any models we do here, unless we start adding new returns in. So yeah, the stock market earned over this time frame 10% annually. And you'd be like, 10% annually, that's great. We're only pulling out 5. What's the problem? The problem is how those returns were structured. And we had a big negative return in year 1. That was sort of the problem we saw. Bonds, not a really great 7-year run lately. Land holds fairly consistent when you consider income and appreciation. So the last thing that we're kind of doing on this table, for those of you nerds out there, we've got correlation numbers, and that's how these asset classes behave with each other. For our particular sample, stocks and bonds were almost negatively correlated, and land was negatively correlated with stocks too. That's all about sample size. The longer periods, the less that negative correlation's there. But it is kind of interesting to see it over a short time frame And I think that goes to speak a little bit on that we look at these long-term projections and models, but when we apply them to our personal retirements, things get a little scarier. The last thing that's on this spreadsheet is going to be the actual returns our clients faced. So we can look at those returns, take those 7 numbers and find the average, right? That's what that geometric return was. But it's not actually what happened. So if you look at it from a time value of money perspective, we put $2 million in a bucket, and then we pulled out 100, 103, 106, 110. This is the inflated amount we're pulling out, and we're left at the end with a certain balance. So if you figure what was the actual internal rate of return our clients faced, it was anywhere from 8 to 3 based on kind of what we started with, what we ended with. In all of these scenarios, our client was okay. They had resiliency and they popped back. But if we started changing these numbers around and built sort of a worst case scenario out, it wouldn't be quite as rosy. So in our next conversation, we're going to build a bit of a worst case scenario, and we're going to show how sequence of return risk can really sink a portfolio.